Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. HSBC and Deutsche Bank earnings beat estimates, soothing investor concerns. But European companies continue to caution on the effects of Donald Trump's levies, with the president approaching 100 days in office. Former central banker Mark Carney leads Canada's Liberal Party to a fourth consecutive election victory, but looks set to fall short of a majority. Plus, power supplies in Spain and Portugal are nearly back to normal after one of the worst blackouts in Europe's history crippled activity in both countries for nearly a day.
Let's get a quick check on these markets here. Fairly calm, perhaps before the storm that you are seeing in the futures picture. Virtually unchanged when it comes to Eurostock 50 futures. Slight outperformance when it comes to the FTSE 100. To me, what's so striking is these currency pairs because the dollar is stronger today. 113 on the euro, 134 on cable. The countdown to the opening trade starts right now.
Tuesday morning, good morning, and we turn to earnings. It is a massive week, it is a massive day for earnings, and there is one theme that seems to tie them all together, and that, of course, is tariffs.
Yeah, that is tariffs. Guy, good morning, everybody. Let's have a look at the AstraZeneca numbers then. Speaking of those that are breaking right now, they look strong. Core EPS coming in at 2.49. That's ahead of the estimates, reiterating their revenue and core EPS guidance, which, with tariffs in mind, is perhaps not a bad state of affairs to be in. So lots to talk about, Kriti, when we get to speak to the CEO, Pascal Soriot. We'll talk about tariffs. We'll talk about the outlook for Europe, for the United States, for drug pricing, and crucially for this business, for China as well.
Let's go to another major company. We've got our eye on that, of course, is BP here. We're seeing headlines that are a little bit of a mixed bag here. Share buyback to the tune of $750 million that they're announcing. But when you look at their EPS numbers, quite a bit of a miss. We're looking at 875. The estimate there was about 10.1, and an increase in their net debt as well. When we're looking at BP, that's one to keep in mind.
There's a bunch of earnings that really stand out. So Deutsche, I think, is really interesting in terms of the banks that we've seen reporting numbers. You've also seen HSBC out with numbers too as well this morning. But there's lines in Deutsche that are fascinating. Seving sent a letter off to staff. He talks in that about additional provisions as a result of tariffs. And it's interesting that basically the macroeconomic environment is already having an impact on what he sees going forward from here. And they're above. I'm fascinated to see what happens on the call and the conversations that we have with that bank this morning, just to define exactly what is going on and why they're seeing that.
So this is a sector that is sort of one step removed, perhaps, from the tariff impact, and actually benefited in the first quarter from FIC trading. We've seen that with all the other banks as well, haven't we? So there's that dimension to it. But even there, as you say, there is some level of caution, some talk at HSBC about what this might do to consumer, sentiment and the like. I think important on the tariff story, though, just to backtrack the sort of top news line around tariffs, is this potential for a rollback on some of the autos tariffs overnight. And I think that's worth noting, because we're going to be deeply into a lot of these earnings stories over the next 24 hours and perhaps missing some of that move back.
I just wonder whether this is being slightly over-egged. He is going to be speaking, Trump is going to be speaking tonight in Detroit. He needs something to announce. He is basically dealing with an issue that the auto industry has been talking about for a few weeks, which is double taxation on the tariff front when it comes to aluminium and steel, plus also auto parts. You're getting taxed on both. So they're being pragmatic and removing that. That seems like a logical thing to do. Also just removing some import tariffs on products that are made in America but key components that aren't, which again seems fairly pragmatic. And this doesn't feel like a tone shift to me in any shape or form.
No, I mean, you could try and bill it as a walk back by the Trump administration, but they're not billing it that way. They're saying it's a victory for the way that their policy is crafted, and it's a reimbursement, to your point. You don't avoid the tariff, you just get reimbursed for some of it. Let's just have a quick mention of with that in mind, though, the autos earnings story is really worth mentioning as well, isn't it? Porsche, return on sales seen at only 6.5% this year. That's down from 10%, Kriti, which just goes to underline the extent of the tariff threat to this sector.
Absolutely. I think it's fascinating speaking in Detroit today. He's going to be speaking to a group of people that don't traditionally vote for the right. So he's really speaking to kind of those union workers as well. And that's interesting because it's coming at the same time as we're talking about his approach towards likes of Mexico and Canada, completely kind of separated from how he's approaching the rest of the world.
But back to the Porsche, this is the second warning from Porsche. We had one in February. You've now got one again coming through now. The effect on Porsche is really interesting. Fran's going to be talking to the Ferrari CEO a little bit later on. And it feels like Ferrari's got a very different pricing point in the US. It can raise prices, probably does so quite effectively. Porsche maybe has a different story, maybe a bit more mid-market in the luxury space. So it's going to be interesting to see just how we separate and slice this story.
So it is interesting. We've heard from Ferrari, Mercedes, Renault, all of them giving us slightly different reaction responses to President Trump. And we see that from the political Cardra as well, don't we? Different politics at play, and fascinating to watch with that in mind what's going on in Canada right now.
So I think this is a really important story in terms of what we are seeing today. So Canada comes through and delivers an outcome that is in some ways a surprise but not a surprise. So Carney wins, but he doesn't win by kind of very much, and he's likely to have a divided government. This is going to mean that basically Canada is going to struggle in terms of the stability of its government at a time when it needs stability and needs to be able to deliver effectively against the Donald Trump presidency down in Washington. And it does feel as if Canada in some ways taken a step forward today, but a step backwards. It is going to have an unstable situation politically, and it's going to be really difficult. The Premier of Alberta is already pushing quite strongly, making demands. It feels like Canada is divided today, united behind Carney in a way, but still divided.
And we're already, just a few months into the Trump administration the second time around, we're seeing it having an impact on politics globally. This was not, 6 months ago, this was not the outcome that people expected. The Conservatives were doing really well, and that's not what has come to pass this evening.
This political pendulum that keeps shifting into the extremes is really fascinating. You mentioned that the Liberals just weren't doing that well, as shown by Justin Trudeau's very public stepping back from power as well. To me, I think it's the policy that's really interesting here, because what can you really do from Canada's perspective? What can Mark Carney do? He's been talking about really kind of building up the defenses against Donald Trump. He's talking about pushing back against the tariff policy. How do you do that, to your point, with the divided government?
He needs precisely. He needs a stronger economy, basically. He needs to solve some of the productivity puzzles that Canada faces right now, and he needs to do all of that relatively quickly. But his job number one, we haven't heard from Trump yet, and I'm waiting for Trump to post on this subject, and I think it's going to be fascinating to hear what he has to say. Yeah, precisely. Because it's going to set the tone.
Yeah.
And I think it'll be really interesting how he sets the tone going forward. Now he knows who he's going to be dealing with.
Well, this idea of government responses, I think, is one that you can look around the world, not just in terms of tariffs and the geopolitical risk there as well, but even in terms of the reaction function around disasters or natural disasters or even man-made disasters. And that's where I think Spain and the story there is really front and center, because it's now the second major emergency that the Spanish government has now issued in the last 12 months or so. The first, of course, being those kind of torrential floods over in Valencia as well. We are now hearing that, of course, the majority of power has been returned. This is a live shot at the moment from Atocha, Madrid's train station, or one of the subway stations, I should say, or metro stations, as Europeans call them. But you can see how crowded they are. You can see that the electricity is not fully back. A lot of the folks really heading towards these places to find places that do actually have the power. And, of course, we are waiting to see what the reasoning behind some of those power outages actually were.
My takeaway from this is that, A, we need to figure out our grid system in Europe, because this is the second incident in the last few weeks. Heathrow is the obviously other one that stands out. We've got to figure out, if we're going to electrify our economies, we need those economies, we need those grids to be stable. And the other one is taking a step back. Have cash.
Have cash, yes. Yes, indeed.
Because if you can't pay for anything, it's going to be... So it's interesting, some economies in Europe are now suggesting, I think it was the Swedes said, just have some cash, have a few 100 lying around. I know that's obviously sounds like a lot of money for a lot of people, but you need to have this ability, if the system goes down, to be able to carry on.
Best day ever for all those people who've always argued that the best place to keep your money is in a shoebox under the bed. Let's talk about what's going on with beer sales, shall we? At, 8 minutes past 7 on this Tuesday morning seems appropriate. We're getting numbers from Carlsberg, still seeing full-year organic operating profit up by 1 to 5%. That's the range. Just looking at some of the numbers, first quarter organic revenue coming in minus 1.5%. The estimate was from something a little brighter than that. So let's get the perspective from the CEO. Jacob Aarup-Andersen joins us, the CEO of Carlsberg. A very good morning to you, Jacob. Thank you very much for coming to talk to us. Busy earnings day, lots of European corporates reporting, so let's get the Carlsberg perspective. So just dwelling us a little on this organic revenue drop of 1.5%, but you are sticking to your full-year organic operating profit target. So anything we need to understand under the hood there?
No, I think, of course, there's always a lot of moving parts in a result like that. But when we look at the first quarter, it's an approved start to the year. So it's slightly a bit softer than last year, driven mainly by the fact that we are exiting the San Miguel relationship in the UK, and the timing of Easter is in Q2 versus Q1 last year. So overall, there's no drama. We maintain, as you said, the overall guidance for the year. It's been an approved start to the year, a bit on the soft side, but that was expected given both the tough comps from last year and that the global consumer is a bit hesitant in spending patterns. But this is results as expected.
The global consumer is a little bit hesitant. Jacob, good morning, it's Guy. Can you elaborate on that, please?
Yeah, good morning, guys. So, we've seen in our industry, I think, across fast-moving consumer goods, we've seen 18, 24 months now of a global consumer that is just a bit hesitant in its spending patterns. When we look at Q1, it's a continuation of what we've seen in previous quarters, so no major step change in terms of how consumers are behaving. But of course, with the global trade uncertainties we're seeing at the moment, we would expect that the subdued consumer to continue for a while. That being said, as I said, no major change in the overall dynamics. We're super excited to see that the growth categories that we've been focusing on are continuing to grow again in Q1. You're seeing alcohol-free beer sales up 15%. You're seeing our premium beers up 4%. You're seeing beyond beer, so other alcoholic products up 6%. So overall, it's an exciting quarter in terms of where we've been focusing our resources.
Jacob, it's Kriti in London. Talk to us a little bit more about that consumer resilience, specifically when you're comparing the likes of the United States versus China. Is there one sector or one region of the world that comes out on top from your vantage point?
So when we look at our global portfolio, we're not very exposed to the U.S., which I guess in these days with what we're seeing on tariffs, it's a minor plus. When we look at our global exposure, China came out in Q1 with a 2% growth, which is definitely very well approved compared to some of the issues we've seen with the Chinese consumer over the last number of quarters. So good strength in China on a relative basis. India, very strong for us, double-digit growth. And also UK, which is a major market for us, actually powering quite well ahead for us as a business in Q1. So three major economies for us, China, India, and UK performing well. Western Europe, a little bit subdued, but part of that is due to weather and timing of Easter. And then you can see some elements of Southeast Asia a bit weaker than potentially expected. So I don't think there is one clear trend. I think you're seeing the power of our local franchises being more important than global economics.
Can I ask you about one of the things you've been busy doing in the UK, Jacob, is taking on Britvic. What kind of difference is that going to make to your business?
Oh, we're super excited about that acquisition. So we are, as we stand here, we're a bit more than 3 months into the full ownership. Everything is going according to plan. We're very pleased to announce today that we're fully on track on the execution of the integration. Synergies are on track, and generally we've been positively surprised by the momentum in the underlying business, the quality of the people and the assets. What it gives us is that our combined business across beer and soft drinks is now the biggest beverage company in the UK, and it gives us a number of advantages in terms of operational synergies, but also in terms of the proposition where we can put in front of our customers. So we're seeing a lot of early excitement from customers and consumers in the UK. It gives us a much broader category to play for. And it also means that no matter the occasion, no matter the demand from a UK consumer, we can serve it on the beverage side. And I have to say, early signs are very encouraging.
Jacob, the British Retail Consortium is out with data overnight talking about grocery prices, inflation there hitting an 11-month high. What are you seeing on the inflation front? What is happening in terms of input prices? How much elasticity there is out there in terms of that subdued consumer you're talking about, in terms of pricing power you can push through? Can you just give us a sort of start of the supply chain, end of the supply chain, consumer kind of read-through as to what is happening?
Of course, Guy. Give me an hour, then I'll start from the first four materials.
That does sound. I agree. The question did open it up.
No. Yeah, just kidding. But listen. First of all, I think it's important to note, as you also say, we are continuing to see certain elements of inflation through the supply chain. So this notion that inflation has come off and it's no longer through the supply chain is just not right. So we're seeing elements, especially on the packaging side, we're seeing clear elements of continued inflation. So that's also why we've said as a company that we will continue to see some level of price increases across the board. I'm not speaking specifically about the UK because we're not allowed to talk about pricing in specific countries, but we have said that we will continue to price underlying inflation through. So it's not gone. Inflation continues to work its way through the supply chain. And I think all diligent companies are, of course, addressing that on the pricing side. So in terms of consumer elasticity and consumer ability to absorb this, I think when you look at the last 18 months, where you saw some quite significant price increases across all consumer goods, we did see the consumer be a little bit wary around further price increases, and we have seen some reactions in some markets where people have been holding off a bit and responding to that elasticity. But I don't see a scenario where we suddenly go back into deflation across our core markets. It is still an inflationary underlying environment. Wage agreements are still high across Western Europe, so it will continue.
Jacob, if you ever got a spare hour, a drink of your choice, maybe I will happily catch up and talk about price inflation in the supply chain. Thank you very much indeed for joining us this morning. We really appreciate it. Jacob Aarup-Andersen, the CEO of Carlsberg.
Yeah, he can come do it around the desk. We probably have to not drink beer at the same time. But
well, why not? He should bring it with him.
Brit makes plenty of soft drinks, so maybe choose from one of those. Right, coming up on the programme, you don't want to miss our other interviews with CEOs coming up thick and fast this morning. The CEOs of AstraZeneca, Citroen and the Norwegian Wealth Fund, all of those taking place over the next 2 hours of programming. Plus, we'll see how tariffs have been impacting Europe's corporates at the open of trading today on a big day for earnings. Up next, BlackRock's Tom Becker joins us to analyse global markets and the consequences of the recent levies on US assets. If you have any questions of your own for our guests, please send them to us on ID plus BBTV Go. This is Bloomberg.
I have a question. Who's ready? Who's ready? Who's ready to stand up for Canada with me? And who's ready? Who's ready to build Canada strong?
Build Canada strong. That was the Canadian Prime Minister, Mark Carney, speaking a short time ago. His Liberal Party, of course, now projected to win a fourth consecutive election. Bit of a surprise. Carney, of course, a former central banker, Governor of the Bank of Canada, Governor of the Bank of England, vowed to boost economic growth and stand up to Trump in this trade war. Let's go to Bloomberg's Vancouver bureau chief, Thomas Seal, who joins us now. Let's talk a little bit about kind of what happens next. We find ourselves in a situation where we have divided governments, effectively. We have a prime minister in place, but it's going to be unclear as to whether or not he commands a majority. What impact is that going to have in terms of his ability to build Canada strong?
Yes, that's the nail on the head. It's a very narrow and uncertain path for him to get a razor-thin majority. They're still counting the final small percentage of votes, and it's technically possible, we think. But at this point, he may have to work with another party. That's what his predecessor, Justin Trudeau, had to do. He worked with the New Democrats, which are a left-wing party here. Now, they've been really slashed down to size in this election. They got squeezed completely between the two big parties. Canadians have polarized between blue and red. That said, if he works with them, they could form a government. They could form a coalition. But that's not really going to be an easy path forward because he wants to increase energy exports and he wants to do things that they may not want to do with him. So the other coalitions, he might want to work with the Bloc Québécois, but they are also against pipelines, something that Carney has talked about wanting to do. So yes, it's looking quite complicated for him to do half of what he's promised he'd like to do during the campaign.
We'll see what happens next. It's going to be interesting how the politics settles out. We'll wait for the Trump response as well. Thomas Seal, our Vancouver bureau chief on the election in Canada, thank you very much indeed. Let's talk about how markets have reacted to the first 100 days of the Trump presidency and talk about how their reaction is going to shape what happens going forwards. Thomas Becker, Senior Macro Portfolio Manager at BlackRock and Lead Portfolio Manager on the Tactical Opportunities Fund, the firm's global macro liquid alternative fund, joins us around the table. Good morning.
Morning, guys.
Thanks for bringing the nice weather from California. So
you bet.
Appreciate that, first of all. In terms of what Americans are bringing to the table right now, I'm really curious as to the balance between what domestic investors are doing in the United States and what foreign investors are doing in the United States. If I look at what is happening and the data flows at the moment, it looks like foreigners are continuing to sell, despite the fact we've seen a little bit of stability in the recent in markets recently. Is that an opportunity for domestic investors, and do you expect foreigners to continue to sell?
So, great question. I think kind of the global rebalancing that we're seeing post-Liberation Day and the tariff announcement is going to be a really important determinant of markets this year. it all hinges on the consumer and the path of the economy. So they're at the worst of kind of earlier this month, a recession was priced in U.S. equities, in the fixed income, kind of, the forward rates. A lot of that has come out. And I think if you're looking at sort of some of the behavior of U.S. consumers, it points to them not really being as impacted by this as maybe the sentiment measures would have you think, or as the magnitude of kind of the effective tax increase that the
just too early.
I think it's a pretty services-based economy. It's a pretty closed economy, right. And so I think the real important thing to think about are the longer-term dollar and yield implications of this. So U.S. runs twin deficits. We have a big primary deficit. It's growing with the big, beautiful bill that is being negotiated now. It keeps getting bigger. And we also rely on foreigners to finance kind of our ongoing current account deficit. And so foreigners sort of stepping back and sort of having second thoughts, how well will my purchasing power hold up if I invest in long-end treasuries? I think that's been a real development this month that could continue as we see pressure on the long end of the curve.
So the argument against all the panic and all the kind of anti-American asset sentiment is that this is just a rebalancing, coming back to neutral and pulling back on overexposure to the states. So what does neutral exposure to the U.S. look like in a portfolio?
Great question. If you think about Q4, where it was all about American exceptionalism and, people were actually selling their foreign holdings to buy more U.S. equities, you've had a complete reversal of that. And I think the way you frame it is right, which is, or maybe we had a neutral place here. And if global growth is okay, your previous guest, Jakob, talking about kind of strength in Chinese consumer and Indian consumer, U.S. exceptionalism was kind of the only place you could get economic growth. The only place you could get earnings growth for a couple years there was the U.S. Europe was kind of in a recession. China was having its own problems. We think there's kind of a global lift happening. It was happening before the tariffs. And so if you have global growth, the U.S. can kind of rise with kind of all of the kind of global consumers in that case.
Yeah, and Thomas, if you're looking at tactical opportunities then right now, given the big moves we've seen in markets, it seems like you're saying the same moves will continue. So weaker dollar, higher yields. Those moves we've seen since the market started to get spooked about tariffs, you think that's a big tactical opportunity to continue to follow that trend? Yeah,
and I think in the U.S., tariffs are inflationary, weaker dollar inflationary. That's bad for kind of long-run yields in terms of their real purchasing power. I think if you look globally, we're seeing more dispersion. So in the UK, you had kind of echoes of the mini budget this month and people saying, oh, maybe, gilts are a sell also. But the situation in UK bond markets is quite a bit more stable than it was a couple years ago.
Too much read across.
Too much read across in Europe. We've been buying a lot of duration in Europe and the UK. We feel like the term premia in gilts is too large. Bank of England has kind of a labor market that's softening much more than in the U.S. A stronger currency is deflationary. They export to the U.S., so it's a bit of a growth hit. And then you've got kind of, little nuance aspects of the debt market where active QT sales may kind of wind down a little bit. Debt management office maybe kind of will issue a little bit more on the front end. And so I think the events like this typically cause dispersion where people think all markets are kind of, the same for a few moments. And that's an opportunity for us to kind of find where the differences are.
I look forward to seeing how that all plays out. Thomas Becker, lead portfolio manager at BlackRock, joining us around the table this morning. We thank you so much. Coming up, we're going to go right back to the earnings conversation. AstraZeneca reporting higher profit driven by the company's diabetes drug sales. The CEO of the company joins us on the program next. Stick with us. This is Bloomberg.
Welcome back to the programme. We're 30 minutes away from the opening trade here in Europe. It is only 7:30. Feels like a lot later. We've dealt with a lot of news this morning, a lot of corporate earnings coming through. This is the picture that futures tell us could come to pass across European equity markets. We could see quite a divergent picture, it looks like. And we have a number of corporate earnings stories to focus on, from the banking sector to the auto sector, drug space, all of those sectors very much in focus today. So we'll see how all of those play out across the various different listing venues. In terms of the bond market story, we saw a little bit of calmness coming through yesterday in treasuries, and no trading in treasuries overnight because of Japan closure, but we're up and trading again there, of course. We see slightly higher yields across treasuries right now. And there you go. This is the picture across the European bond market space. No very big moves this morning, Guy.
Pretty.
Yeah, let's go straight back to the earnings story as well. AstraZeneca specifically posting higher profit in the first quarter, driven by sales of diabetes and cancer medicines. Now, the British drug maker confirmed its guidance for the year and also said it was committed to investing and growing in the United States. I'm pleased to say we're joined now this morning by the CEO of AstraZeneca, Pascal Soriot. Pascal, pleasure to have you. Thank you for taking the time out of your busy morning. Let's start it off with some of these earnings as well. Walk us through where the growth is largely coming from as we laid out there, but also maybe where the risks lie.
Yeah, good morning. Thank you for having me. It's really a pleasure. And indeed, we had a very good first quarter. We're very much on track for our guidance this year, and also very much on track to our goal of $80 billion for 2030. Actually, the growth is coming from across the portfolio. Oncology is growing nicely, but also what we call biopharmaceuticals, our diabetes products, our respiratory products, and also from every geography. The United States is growing nicely, Europe, emerging markets, even China grow by 5%, but we have a product called Pulmicort that is losing patent protection, and if you exclude this, China grew by 9%. So very, very pleasing results across geographies and across the portfolio of products.
Well, Pascal, let's talk about one of those geographies specifically. In your latest results, you're talking about being committed and even doubling down when it comes to your exposure to the United States. Of course, that's going to raise a lot of eyebrows around the world when it comes to the tariff threat. What kind of risks are associated with that kind of investment?
Well, we actually, believe in innovation. We are an innovative company. We have a large portfolio of new products. And the United States is the market where innovation is taking place in our industry. So we have been long committed to investing in the United States. We have spent the last few years building a network of manufacturing sites covering the three main geographies, the US, of course, Europe and China. And suddenly, what we experienced during COVID gave us a further incentive to invest in this manufacturing network. So we have 11 manufacturing sites in the US. The great majority of the products we market in the US are manufactured in the US. We export from the US, so we are well covered from that viewpoint. We pay our taxes in the US, so we actually are, a very US-centric company in many ways, even though we are incorporated in the UK.
Yes, and no doubt very well connected, Pascal, in the US. Good morning. Can I ask you what conversations are taking place about tariffs? Because we know about the broad tariff landscape, of course, from a US perspective, but not about sectoral tariffs on the drug sector. And I wonder what you're thinking is going to happen there.
Good morning. And it's a great question. And as you can imagine, of course, there are discussions at very different levels with the administration and people in charge of managing those tariffs. But the industry really is trying to advocate for no tariff for pharmaceuticals. We believe that it's important that medicines should be made available across countries so people can have access to those medicines without disruption of the supply chains. And we actually believe that better incentive to attract investment in manufacturing and in R&D is to have a great tax policy that incentivizes companies to invest in the country. So our industry approach is we will invest in the United States, and we as a company are investing a lot. The industry as a whole is investing a lot, but we believe that tariffs are not the best way to manage this to manage pharmaceuticals.
Yeah. And knowing all you do about the way the US drug market works, Pascal, if prices go higher as a result of tariffs, who will pay for that? Will it be your suppliers? Will it be your margin? Or will it be US customers?
Well, we hope there will be no tariffs, actually, Anna. But of course, if there are tariffs, we will have to manage those. In our case, as I said a few minutes ago, because of our investments in manufacturing in the US over so many years, we now have 11 sites, and actually we are able to manufacture locally. So if there were tariffs to put in place, we would be able to manage because we manufacture a lot locally in the United States. So it would not affect us that much. And the couple of products that would be affected by those tariffs, we are basically already working on redeploying the manufacturing of those to the US. So any impact would be short-lived. So this issue is not the most relevant issue for us as a company.
Pascal, good morning. It's Guy. There is an argument doing the rounds in the pharma sector that American prices aren't too high, but European prices are actually too low. Do you see any chance that European governments are going to raise the price of drugs on this side of the Atlantic?
It's actually a great question, Guy. I mean, if you look at it, innovation in our sector has been mostly paid for, if you will, by America, really. And it's clear that Europe in particular and the richer countries in the world have to invest more in pharmaceutical innovation. They have to allocate a greater share of their GDP to pharmaceutical innovation, just like they have to allocate a greater share of their GDP to build their own defense industry or their own defense in Europe. Same mechanism here as it relates to pharmaceutical innovation. The model is unbalanced, too much funding by the United States, and Europe has to really lift investment in pharmaceutical innovation. That's very simple. To me, it's a question of sovereignty. If Europe wants to have sovereignty over the health of its citizens, it has to accept to invest more in pharmaceutical innovation so patients can access those new medicines.
How much more? What is the gap, do you think? What are we missing here? There's obviously a huge push in Europe at the moment to increase defence spending. What should we be doing in terms of healthcare spending?
Actually, if you look at it, I'm not talking about healthcare spending. I'm talking about pharmaceutical spending.
Okay, sorry,
because
drug
actually,
spending. Sorry, my mistake.
Many of these countries are actually have healthcare spending as a percentage of GDP that is very similar. But it's a question of, out of this healthcare spend, how much do they allocate to pharmaceuticals, and in particular to innovative pharmaceutical products? And we are talking about, as a percentage of GDP, the allocation of GDP to innovative medicines is less than 1%. So it doesn't, we're talking about, moving from maybe 0.4 to 0.7% of their GDP. So we're not talking about massive amounts of money. But those budgets are really critical if we actually want to ensure that patients in Europe get access to innovative medicines in the future. The issue is that many countries have reduced their share of healthcare budget going to pharmaceuticals down to 7, 8, 9% from what it was a few years ago, 12, 13% of total healthcare costs. And in the United States, we're closer to 13, 15%. So the countries that are 8, 9% are much too low. They have to redeploy budget.
Well, Pascal, let's bring it right back to the United States here, because so much of or a good chunk, I should say, of your supply chain extends from the United States across the world and into China as well. In previous iterations of interviews we've done with AstraZeneca, there has been an ongoing question of whether you foresee pressure from the U.S. administration to remove supply chains that extend into China. Are you seeing evidence of that?
We haven't seen evidence of this. I mean, of course, we've seen the implementation of tariffs that everybody knows about. We haven't seen evidence of removal of supply chains. In fact, again, as I said before, we've been building a supply chain in the United States as a priority, but also in Europe and in China. Over the last few years, we've invested in manufacturing in China. So we don't import products into China from the United States. We had a couple of products left coming from the US. We've moved that manufacturing to China. So China is in many ways self-sufficient, and Europe is, and the US is. So we've really worked hard to build three supply chain that covers those three major geographies.
Pascal Soriot, CEO of AstraZeneca, we thank you so much for your time this morning and joining us after that earnings. Coming up on the program, we continue the focus on the corporate sector. Citroen unveils its new C5 aircraft as President Trump's tariffs weigh on the global auto industry. The company's CEO, Terry Koskas, joins the program next. Stick with us. This is Bloomberg.
Good morning, welcome back. 16 minutes to the market open. Both Porsche and Volvo car out with numbers this morning, both ringing the alarm on the impact of US auto tariffs on their bottom line. The Volvo CEO saying the tariffs, quote, represent a massive disturbance to operations for his business. Porsche, once again, issuing a profit warning. We had one back in February. We've now got another one coming through. The company is facing a host of challenges, including the US tariffs, higher costs, and also weak EV adoption, which is interesting, considering what is happening in the auto space right now. The commentary comes as President Trump is expected to blunt the pain of tariffs on US automakers later this evening by lifting some levies on foreign parts for cars that are made in the United States. Let's get another perspective on what is happening in this industry. Citroen is unveiling its new C5 Aircross today. It's an update from the French car maker. It has a current model. It's updating that model. The new model comes with an all-new design. It's got an interior that is all new. It's now available as an EV. We've got a hybrid version. We've got a plug-in hybrid. You've got an EV version. Joining us now, Thierry Coscas, the CEO of Citroen. Good morning, Thierry. Thanks very much indeed for joining us. So you're making the shift to electric vehicles with the new car. And I'm just wondering kind of which version of these various iterations of the powertrain you think you're going to be selling more of. What is happening in Europe right now? Do people want EVs or do they want hybrids?
Well, actually, I would say both. It very much depends the countries. We have some countries that are well developed in EV. If you take, for example, Scandinavia or France or other countries. Others that are probably a bit more remote in terms of electrification. But I think that the trend towards electrification is something that we cannot stop because at the end of the day, this is the only viable solution to reduce CO2 emissions. With the all-new Citroen C5 Aircross, we are offering full electric, but also plug-in hybrid and hybrid version. So all the engines are electrified, but we think that the full electric version will sell very well and will grow its share in the future.
Thierry, good morning. Thanks for joining us. Let me ask you about innovation and where it's currently coming from. Some of our team covering the Shanghai Auto Show, we're talking about the level of innovation we see coming out of China. Also, we see headlines almost month after month talking about how little time it takes to charge some of the models coming out of China right now. How much is China setting the pace when it comes to innovation, even if you're protected from direct competition with them to some degree in Europe?
Well, actually, you know, we don't rely on any protection to survive or to live against the Chinese competition. Why? Because simply protection comes, goes. So we need to be able to fight against the Chinese competition with the same weapons, which is cost from one side and technology from the other side. On the cost side, Citroen has been the first European brand to offer affordable electric cars. We launched, as you well know, the EC3 at 23,000 euros back a few months ago. On the technology side, you're right, there are a lot of benchmark and interesting things to see from China. But if you take the all-new C5 Aircross that is behind me, it comes, for example, with level 2 semi-autonomous driving. It comes with an outstanding range of 680 kilometers in full electric on the electric version. So, yeah, we shall not be ashamed of the type of technology we are also offering on European cars.
Terry, it's Kriti in London. So much of the move towards electrification has become with the support of government subsidizations or tax credits or incentives of some sort. But in the last, I want to say, couple of years, certainly in the last 12 months, you've seen a lot of that pulled back from the likes of the States, the UK, Germany, and several others. How do you make EVs affordable without that government support?
Well, actually, this is a great question and this is a great challenge. We shall not rely on government incentive to, be able to sell electric cars. When you offer an electric car at 23,000 euros, it's the case with the Citroen EC3, without any incentive, we think it's affordable. Today, we are going also to announce a lower range version, 200 kilometers, at less than 20,000 euros. So, we are talking about prices that are very, very comparable with gasoline cars. So this is why we think this is the solution. We shall not rely again on getting government incentive, for sure.
Thierry, how would you assess consumer sentiment right now in Europe? Is the consumer ready to buy a new car? It seems that cars are getting a little bit older and consumers are getting a little bit more cautious. What do you think is happening out there?
Well, actually, the market is cautious. Yes, depending the countries, some of them are up, some of them are a bit down. I think that there is some cautiousness because there were so many talks about what type of energy should I go for. We can see that the prices of cars have increased in the past and so on. Now it's really time to regain the confidence of the consumers by doing two things. First of all, offering affordable products. That's what we try to do, and we do at Citroen. And number two, give confidence on what are the energies for the future. I mean, someone who buys today an electric car is making the right decision. We are accelerating in electrification. Well, actually, we know that not all the customers will be interested by buying an electric car. That's why we are also offering hybrid version. But electric car, we need to give confidence to the customers to say it's the right choice for the future.
Thierry, do you have concerns about grid resilience in Europe, given what we saw in Spain and Portugal yesterday?
Well, actually, I think that resilience is part of our DNA, and it's part of particularly the DNA of the car industry. I mean, we live in an industry that is never quiet. There are always one crisis after the other, and it's part of our DNA to be able to resist to any type of crisis.
Thanks very much, Thierry. Thierry Koskas, the CEO of Citroen. Thank you for joining us this morning. 7:50 here in London. Let's take a few minutes to talk about the broader market themes. We're joined by our Markets Live executive editor, Mark Cudmore. Mark, we're deep into earnings season here in Europe. The futures look kind of mixed for Europe. US futures point tentatively higher. Overlying all of the earnings stories, we have a little bit of movement on tariffs. Where's overall sentiment, do you think, right now for risk assets?
We're in a holding pattern. Good morning, Anna. I think a lot of people are very excited, not only by those big earnings, but of course we have a lot of macro data this week. Wednesday data is the one that a lot of people are talking about. We obviously get GDP and we get a whole kind of slew of kind of higher frequency indicators as well. But most of the readings we're going to get in the next kind of 36, 48 hours are in fact from March or from the first quarter, and therefore less relevant because they're before the reciprocal tariffs were announced. I think what's probably the more interesting data is the stuff we get on Friday, which the ISM reading will be very, very important there. I think it is still the survey data, the soft data, that we're having to take the lead on. I know that everyone highlights that in COVID, the soft data and the hard data never reconverged, and the soft data is misleading. I'm not sure that's necessarily going to be the case this time around. And I think it is. So the soft data is what we're getting at the moment because the hard data for April is not yet coming through. Now, one final point in the data is a lot of people are very excited by the jobs data on Friday. Claims have not shown any cracks yet, and I don't understand why people expect NFP to show a material dip when we haven't seen any sign of weakness in the claims data. I think we won't see the jobs market materially weaken until mid-May at least. So I think we're some way off that. So people in a holding pattern, people are getting excited about Wednesday's data, but it's really Friday's ISM that's most important this week, and of course earnings.
Mark, a lot of people are getting excited, though, that we have had 100 days of the Trump presidency, and therefore big announcements are coming, and we are going to get some deals done with foreign nations, and we are going to get maybe some subtle changes when it comes to the tariff story, and this is all going to be taken very optimistically. Are we getting ahead of ourselves in terms of our expectations around what we're going to see?
I'm worried we are, but what I'm most worried about is that the optimism still seems to build day by day, because as we get closer and closer, we get another headline from Trump promising a deal soon, and people kind of price in a little bit more optimism, and people are getting very excited about these deals. I think we are going to get some trade deal announced soon. It seems like the earliest ones will come from Asia. India, South Korea, Japan are some of the contenders in there at the forefront of this, and people are getting excited by that. I am worried that, look, real trade deals take months, if not years, to negotiate. I'm worried that anything that gets announced now will ultimately disappoint in the concrete details. So I think as we get more optimism priced in, and as we get close to that trade announcement, that in fact we then tee ourselves up to an asymmetric reaction of disappointment after the headline and people realise, hey, this is nothing substantial. The overall backdrop at the moment is that we're expecting marginally positive news flow from earnings, from the kind of trade deal announcements, from the data, which won't yet have slowed down. And yet the backdrop is a structurally weakening global economy. And that makes it very hard to trade. Positive marginal short-term news against bad long-term news.
All right, Bloomberg Markets Live Executive Editor Mark Carney joining the program this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. As Mark was speaking, we got a headline here that Alphabet is kicking off a sale of its debut Euro bonds. This is a conversation we've had over the last few weeks with some of our credit guests about reverse Yankee issuance.
Yeah, absolutely. About U.S. companies coming to Europe to issue debt. So, and at the time, I think it raised a few eyebrows, but there we are. It's happening.
It's entirely logical, though, doesn't it? I'm just going to use the 10 years. Germany currently trading 2.5 yields. America, US 10-year 2.29. Quite a big gap. And you can understand, therefore, why companies like this are going to be doing this. I suspect many more will over the course of the next few months. We are going to take you towards the market open next. This is what the futures picture looks like. Reasonably quiet start. Lots of earnings to digest. Single stocks are going to matter today. 5 minutes to the market open. This is Bloomberg. Tuesday morning, couple of minutes to go until the session starts here in Europe. There are loads of single stock names that we're going to be needing to focus on this morning. It is the earnings season that is dictating the narrative, certainly today. I suspect that may change as the week works its way through and we get towards the big data that we're going to be seeing towards the back end of the week. But this is the picture coming out of Monday into Tuesday for European markets. We went out here on Europe, on the US session in Europe. We climbed a little bit after that, after dipping initially, as a result of which maybe a slightly more positive picture, a little bit of a tailwind maybe coming into Kriti's futures this morning.
A little bit. Some of it might just be rebalancing flows, as simple as that, because you are seeing marginal gains. But again, emphasis on the word marginal, Anna. When it comes to the outperformer, it goes right back to the DAX higher by 0.4%.
OK, so that's what we're expecting from the futures picture, telling us we'll be a little higher perhaps then on the DAX. Let's go to some of the sectors in focus then, Kriti. There are so many stocks to pick from. We haven't tried. We've just gone sector this morning. So banks certainly in focus. HSBC and Deutsche Bank. Quite a resilient story being told there. On track with goals, according to Deutsche Bank. Better than expected numbers and a buyback over at HSBC. Yes, they're both talking about some of the downside risks from tariffs, but giving some reassurance to the markets in the meantime, perhaps. The automakers is a more negative story. Porsche certainly really negative. The downgrade to their return on sales estimates is something we're watching carefully. We're also looking at Volvo Cars. Their numbers coming in lower than estimates. They've launched a cost and cash action plan. So this is the kind of response we might see from other automakers as they try to get a handle on what's happening to their businesses. On the pharmaceutical sector then, Guy, watch Novartis. This could be a story in the different direction, raising their forecast after profit beats estimate, and AstraZeneca getting a profit boost from their diabetes and cancer drugs. So that sector could move differently to some others, Guy.
And a little bit of help from the tax situation as well for Astra. OK, let's talk a little bit about the final story going into this market open. A lot of corporates to digest. It's going to be interesting to see how the macro top-down interacts this morning with the bottom-up story. FTSE 100, BP is going to be a story in that market. You've got ABF out with numbers too. You've actually got some inflation data I think is worth paying attention to as well, which is the top-down picture there. But the FTSE 100 is up by 0.3%. The Stoxx 600 flat as a pancake this morning. No clear sense of a direction. This is a market that's got a lot to think about right now and is struggling to find a sense of direction as a result of that. The IBEX, obviously, the focus there is what is happening with the national crisis surrounding the electricity grid. That market, interestingly enough, up by 0.2%, pretty much in line with what we're seeing around Europe this morning. You do wonder what the longer-term fallout from that story is going to be economically. The CAC 40, we wait to see what happens there. This morning, the DAX has a little bit of news to digest, as a result of which we're back to normal form. It takes a few minutes to get open. So let's figure out what is happening with the sector story. Kriti, over to you.
Well, we're seeing some broad gains, even though, of course, there are marginal gains. They are still largely in the green, Guy. And I think this is interesting because when you look at the downside, it's two major earnings stories, Anna, that we're looking at. AstraZeneca and BP, from an index contribution perspective, both taking a beating. AstraZeneca down a whopping 4%. I think that's what's dragging down the healthcare index because Novo Nordisk is also trading lower right alongside it. But then BP as well, down about 2.6% this morning. So, of course, commodities are very much in focus. But BP, perhaps the underperformer of that broader sector.
Yeah, interesting to see that energy and basic resources move in very different directions. So as you say, the energy story has the BP numbers in it. We heard from them today, and that stock down by 2.9%. So there's sort of stock specifics, and the oil price is weaker. So we're down by 1% at 65.20 on Brent. Basic resources, though, that sector is going higher. Perhaps if we're looking for a tiny bit of risk on in markets, I mean, that's a stretch, isn't it? But there maybe is that element to it. We are a little bit firmer on basic resources this morning. Banks, the best performing sector, though, as it stands right now. And, of course, we've heard from HSBC, we've heard from Deutsche Bank. Deutsche Bank, their shares opening up by 3.9%, HSBC up by 1.4%.
Yep, just keeping an eye on the defence shares as well. It's interesting, Rheinmetall up very strongly. Preliminary results out this morning. Love a German company. Surprisingly upbeat. Well, not surprisingly, but upbeat, and that's a surprise. The market likes what it is hearing out of that company. Astra's interesting. Weakness there, despite the fact, actually, in theory, this looks like actually a decent story. There's a lot of tax in the mix as well in terms of what is helping out here. But it's interesting to see that Astra not having a particularly strong start to the day. In fact, showing some considerable signs of weakness, which is weighing on the FTSE 100. That stock down by 3.5% this morning. I just wonder if this is about the quality of the beat in terms of what they've delivered this morning.
Maybe. I mean, and in terms of the tariff narrative, he was pretty positive, wasn't he? Downplaying the extent to which this was going to be something that hurts their business.
Downplaying the effect, but also doubling down on the investment, which is, as several of our guests this morning have said, there are pros and cons to kind of building that kind of exposure. Also talk about some broad beats. When you look at the banking sector, Deutsche Bank, HSBC, BBVA, BNP Paribas, all moving the index higher when it comes to some of those earnings stories as well. Let's go straight to our markets desk here. Rory McPherson, CIO at Ren Sterling, joins us around the table. Rory, pleasure to have you on the program. We've seen a lot of volatility in the last month or 2 months, to say the least. Is it over? Is the worst behind us?
I don't know if it's over yet. I think the worst probably is behind us. I think we've seen the bond market serve to put a bit of a lid on some of the more extreme policies from the Trump administration. We saw the rollback last week as bond yields spiked up to sort of 4.4%. Straight after Liberation Day, as bond yields spike, we saw President Trump come out and dial down some of the rhetoric that he'd been speaking about and was a bit more positive on markets. So I think with the debt levels they've got, that $36 trillion of debt and the funding costs around that, I think they will respond to the bond market. So I think as yields tick higher, you will see those policies start to come down. I think that's what we've seen. And it seems the narrative is a little more calm in markets at the moment.
So is the bond market driving the stock market, or is the stock market driving the bond market?
I think, as always, for me, it's the bond market that drives things. And I think economic policy from the Trump administration has clearly spooked the bond market a little bit, particularly US yields at the longer end. And I think that's driven some of the softening in tone from the US administration, which is feeding through to markets. Also, we've had some, as you've spoken about, some really strong earnings that have come through, which kind of got forgotten about. At the start of the earnings season, we had US banks with some good numbers, and we started to see that a little bit more last week in the US with Alphabet, and some numbers this week as well with the UK banks.
Yes, the banking sector seems to show some resilience, Rory, and that's maybe they're a step removed, aren't they, from the tariff question. But some of their clients, some of their customers in specific industries will start over time to be affected, won't they? And I'm thinking now about the auto sector. We've got Volvo Cars down 10%. We've got Porsche under pressure this morning. The theme for that sector, it faces a number of challenges. Even if you get a slight rollback in some of the tariff regime, this is still a sector under pressure. For sure.
For sure, it's a challenged sector. It has been for some time. It's one that's in the eyes of trade policy as well. And I think the consumer is under pressure. We know that. We've seen a little bit of roll forward on spend on some of the autos, but I think the guidance has tended to be a little bit on the weak side, because it's very hard to forecast high spending of a consumer that's under pressure.
How is FX playing into this? Obviously, the strong dollar the weakness in the dollar over recent weeks has been the key theme in markets. I was reading some research by Deutsche Bank yesterday that talked about that continuing. So continued weakness in the dollar, the euro up to 130, they say, the yen up to 114, the pound up to 145. Is this having an impact on your thinking? Are you watching this dollar move intensely, and is that impacting on your strategy?
Well, look, it's a really interesting dynamic when you have the dollar selling off, bonds selling off, US equity markets selling off. It's highly unusual, and it speaks to the policy that's in place. I mean, I think ultimately, the dollar is still a strong currency. The US is the world's biggest economy, and it's got really good growth. So, we're not throwing the towel in on the dollar or US markets at this point.
Yeah, interesting to see the HSBC CEO making that point, saying it's important the dollar stays the reserve currency. The Barclays CEO was saying it. Even European Eurozone central bankers have been saying it's important that the dollar stays the reserve currency.
Absolutely.
Nobody wants to
But if you're a European investor, the dollar is a real problem right now.
Yeah.
So if you put money to work in the United States, let's just say I'm really drawn at the moment by the difference between US investors and European investors. European investors' view on the States is much more pessimistic than US investors is right now. And data kind of speaks to that. So if you're a US investor, the S&P is only down by 6%. Yep. Okay, great. No problem at all. 6%, that's a nice little drawdown by the dip. Happy days. If you're a European investor, year to date, the S&P is down by 15%. Okay? The Nasdaq is down by nearly 20%. And that's the dollar effect coming through. And that kind of explains maybe the difference we're seeing. In terms of being a foreigner wanting to invest in the United States, the currency seems absolutely critical at the moment because you need to adjust for it. If the euro goes to 130, those numbers are going to look even worse. Does that tell me as a European investor to be very wary of parking money in the States right now? Because I'm going to continue to be hurt by that currency story.
Our view is it's too late to hedge that now because obviously the dollar sold off a lot this year. I mean, in the very long term, currency tends to be a wash in equity markets. Yep. So we would look at it and say, actually, now it's a good time to be nudging back into the US equity market. Because as you say, you're adding on 7% to a downfall of 6 to 7% already.
That number could get worse. Well, we could go much higher on the euro. Presumably, the currency effect could get greater, not less. It could undermine any gains that potentially I could make in the US market.
Potentially, but I suppose at some point when the trade issue calms down, we get back to interest rate differentials, and then you're back to the dollar.
Okay. We'll watch that moment. Rory, nice to see you. Thank you very much indeed for coming to see us. Rory McPherson, CIO of Ren Sterling. Core 6 looks like this morning. Some key names do certainly stand out from this story. The auto sector is under pressure, but Ferrari is not. It's interesting, Francine is going to be speaking to the Ferrari CEO a little bit later on. Staying in luxury, though, we are seeing some weakness in LVMH. The pharma sector is definitely back under pressure. A little bit of safety. Look at that bid into Nestle this morning.
Coming up on the programme, we speak to the CEO of the world's largest sovereign wealth fund as investors navigate market turmoil from Trump's tariffs. That interview is coming up next. This is Bloomberg.
Minutes into the session, I have to say, I don't think the indices really do justice to what is happening out there. There are some fairly chunky single stock moves that we are watching. Thoul's down by 11%, Electrolux 9%, ABF nearly 9%, Porsche's down by 7.4%, Schneider is down by 6.22% this morning. There are some really big drops on single stock names as they reveal earnings. The earnings story is interesting. Rheinmetall on the other side, Capgemini, both doing very well this morning. Let's put some of this into perspective. I want to take you to Oslo now. The Norwegian Sovereign Wealth Fund Investment Summit is taking place. Francine is there, and she's with probably the most famous Norwegian when it comes to the world of finance. Fran.
Yeah, the most famous Norwegian. I mean, there are many famous Norwegians, but he's certainly the most famous in the markets. I'm delighted, Guy, to be here in Oslo and to be joined by Nicolai Tangen, the Chief Executive Officer of the Norwegian Wealth Fund. Nicolai, as always, thank you so much for joining us. The markets are all over the place. One minute they're happy, 1 minute they're worried. I know inflation underpins everything. Are the markets too optimistic about what we'll live through in the next 6 to 8 months?
Well, it's a very interesting question. You know, in a way, the world is splitting into two. And that means that we probably will see lower growth, and there is a risk that we will see higher inflation. And so the market is very resilient, given that backdrop, I think.
So, which means that you're expecting maybe a correction? And are there parts of the markets that seem too sanguine at the moment?
Well, we've been saying for quite some time that we think it will be more difficult to make money going forward. And so I suspect with all the uncertainty that we are seeing just now, that we could continue to see, tough times. So
what's it like being in the markets? Do you worry? Is this an opportunity? What does it mean for how you position your portfolio for a long-term investment?
Well, I think the way to behave in the market now is just to be broadly diversified and very, very long-term. You really need to put your long-term hat on. And I think to do, tactical reallocations and movements is very, very difficult because they move so fast. You know, when we last met in Davos, it looked like the US was going to be fantastic from a stock market point of view, and Europe, all the leaders we met from Europe were really, really depressed. Well, you fast forward a couple of months, and the whole thing is just turned upside down. So it's very, very difficult to get these turns right.
But, and Nicolai, what does it mean longer term? Because actually it's unclear where the trade barriers exist, whether market pressure will make the Trump administration do a U-turn. So even 3-4 years, visibility is extremely difficult.
Yeah, no, absolutely. We really don't know how this is going to pan out. I think what is certain is that the long-term trend of globalization, growth, these kind of things, that will look very, very different going forward. So the easy money is not there anymore.
You have over, I think, 50% allocation into U.S. assets. Does that change?
No, we are very happy with our U.S. allocation. We have, big holdings in Treasury, and we have, big holdings in the large companies in America. They are great companies, and we love owning them.
But I mean, okay, treasuries, are they a safe haven? What are they? Because they've been behaving quite differently.
We think it's the safest place you can be.
Still now, despite the market move and some of the uncertainty.
Yeah.
That means dollar stays a reserve currency?
Well, so there are other people who are better when it comes to currencies than me. We, for instance, did a podcast with Ken Rogoff last week. So tune into that one and find out.
I love that I'm speaking to podcaster to podcaster. But Nicolai, overall, so 15%, for example, Europe. Yeah. Are you allocating more to Europe, as opposed to other emerging markets?
No. So what we have a very clear mandate from the Ministry of Finance, which in broad terms tell us where we should be invested. And what we do is we are very, very long term. We stick to the mandate and make just small allocation relative to that. And I actually think to have a long-term plan and a long-term mandate in these turbulent times is a very, very good idea.
But it's hard. I mean, when you look at, for example, the Magnificent Seven, some of the tech stocks, I mean, you were slammed because of the market volatility in those. Yeah. So staying in takes quite a lot of courage.
Yeah, I mean, on the one hand, on the other hand, we are, after having been down, the market is now pretty much back to where it was when you look at the global index. And, the fund is pretty much where we were at the beginning of the year. So you just have to sit through some of this volatility. I think it's interesting when you look at our first quarter results, we were down some $40 billion. Now, that's giving back only 10% of the combined gains of the 2 prior years. And markets don't go up in a straight line. You have to assume some volatility here.
They also don't go down in a straight line.
That's also correct.
Where do they go down first? Is there any indicator that you see for a bigger market correction?
Well, I think it's all depending on what's going on with the trade tariffs and whether you manage to solve the kind of the relationship between the superpowers, right? We are seeing impact now in terms of incoming container traffic into the US and so on. So starts to have some real economic effects.
Nicolai, when you say, I mean, we started the conversation by saying actually there's a split, right? There's a fragmentation around the world. What does that mean for tech stocks? Why are you so still invested in them? Do you think they're immune to it?
Well, so we have, I think if you have this fragmentation, it will have more negative implications for markets. We publish our stress tests every year, and we put them on our website so that people know what we think in the various types of outcome scenarios. We think if you have a proper fragmentation of the world, could be like 35-40% downside in markets.
Did you actually, change your portfolio to maybe add some stocks or certain positions when there was a market rout?
So we have a very delegated mandates within the fund. So some people would have done that, and some people wouldn't. It depends. It's a very high level of accountability in this fund.
Out of the Magnificent Seven, is there one that you think will come up better than others?
It's difficult to say, but. It is what is clear is that AI has really real implications for efficiency. So last year we think we increased efficiency and productivity in the fund by 15% by using the new tools. I think this year will be even higher, and so we are working really hard with it and applying it to the whole tech stack that we have, and it's has got huge results.
What's Tesla? So is it a Trump play? Is it a renewables play? Is it what do you do with the stock?
Well, I don't have a firm or specific view on that one particular company. So I think you can perceive that in many different ways. What it is actually.
So when you look at China, how does China play into all of this? I mean, the biggest fight on earth is probably between the U.S. and China.
Yeah.
How does that change again your position on where you make money and how?
Yeah. So again, we look at China as a collection of companies. We think they have some great companies, and we are invested in those companies. We don't really do, allocation just based on geography. When you look at the U.S. tech stocks, they would have exposures around the world, and just because they are listed in America doesn't mean they are U.S.-only stocks, right? Same in Europe. You look at the big European companies; they are global companies, global leaders in. The Swedish companies are global industrial leaders. In Denmark, you have pharma companies. In France, you have, luxury goods companies. These are global leaders, incredible companies.
But because of the tariffs, are you expecting the tariffs to come back down? Again, you don't know whether a tariff is put in place now.
I don't know. I think there is one guy who knows, and it's not me.
So you just stay firm. Nicolai, talk to me about renewables.
Yeah.
I mean, it's clear that it's not part of the Trump administration focus right now.
Yeah.
What does that mean for how expensive they'll be and actually the transition?
Yeah, we got it into our mandate some 3-4 years ago that we could actually start to invest in renewable infrastructure. And at that stage, these investments were just very expensive, low yield, a lot of competition to get in because everybody was trying to make their portfolio a bit greener. So we did very little. Now it's very different, right? They are not particularly in favor. The potential returns are coming up. There is less competition, and so we can make real investments here at good returns, and that's what we're doing.
Where? Europe?
In Europe and also potentially in the US.
US, so it hasn't. Do you think it's slowed down actually the adoption of renewables in the US?
Well, I mean, it depends whether you are talking about wind or solar. We think they are potentially attractive investments.
What about the less liquid real estate? I know you're tipping your toe into this to because of mandates.
Yeah, well, we're tipping our toe. It's a pretty big toe because we have close to 1,000 properties. We own 25% of Regent Street in London. We own big holdings in Manhattan and so on. I think relative to the stock market, these things start to be pretty attractive. You had kind of a perfect storm with everything from COVID, working from home, regional bank uncertainty and so on in the US. Now, just relative to other alternative investments, I think some of them are pretty attractive.
So less liquid, but actually more attractive in terms of returns. Will you be buying more?
If we find the right ones, yes.
So right ones is what, prime real estate in big capitals?
Yeah, prime has generally done better than less good real estate.
Nicolai, I can't tell whether you're bullish or not on the U.S. because you say invested in the U.S. have 50%. But do you think some of this is an opportunity for Europe to either attract talent, attract companies, and attract capital?
Well, in the long term, U.S. has got a terrific, spirit, innovation, ability, great companies, great management, business models, and so on. What we're seeing now, we are seeing that Europe potentially is getting its act together, taking away some bureaucracy, starting to try to cooperate, merge businesses to make kind of stronger champions. And I think we are seeing the start of that, and I think there is a sense of urgency kind of creeping in there. So it will be really, really interesting to follow. Now, I think you can look at this world in many different ways. You can put on your, you can be worried or depressed and so on, or you can put on your student hat, which is what I'm doing. Your student hat, because we are at a time where things are changing so fast, at the same time as technology development is incredibly fast. And so just to live, at these times and see what's going on here is just so fascinating.
I love your podcast, and you have someone from Formula One. Did you learn anything about leadership, or what's the best piece of advice you've gotten for leaders?
So the Formula One episode is out in a few weeks, and I think what is really fun there is to talk about speed. Of course, they really live in the fast lane. But that's not only about the race, but it's also how they think about speed in the organization, speed in decision making, all these kind of things. Just really, really fascinating. And he's a very, very charming and professional CEO.
I mean, speed. It's like bond traders, March 22nd. Nicolai, thank you so much. Nicolai Tangen, there, the Chief Executive Officer of the Norwegian Wealth Fund. Back to you, Anna, and we'll have plenty more, of course, from the conference here in Oslo throughout the day.
Absolutely. Francine, thank you very much for that. Francine Lacroix, anchor of The Pulse, of course, at the Norway Wealth Fund Investment Summit. As she says, lots more still to come. And stay tuned for our exclusive interview with the Goldman Sachs CEO, David Solomon. That is at 10:30 a.m. UK time. Let's take a check on some of the individual stocks that are on the move. There are so many. How on earth has Charlie Wells chosen? Narrowed down the list. Charlie.
And so we're seeing so much movement in the market on the back of these earnings reports, this spate of earnings reports that have dropped this morning. We got to start with some significant beats. I'm thinking about the banking sector here. HSBC reporting a profit beat. They're up 2.2% this morning, and they were able to announce a $3 billion buyback. That's got to be pleasing shareholders right now. Another banking beat, Deutsche Bank. Their CEO said they had the best quarterly profit in 14 years, up 3.5%. So significant beats in the banking sector there. I want to talk a little bit more about the automotive sector, however. We've got Porsche and Volvo also out with reports. We've got a kind of different picture here, a lot of red on that screen. Porsche, you know, they have no capacity to manufacture in North America. That leaves them vulnerable, and they had a significant miss, down 0.79%. And Volvo Cars had to withdraw their guidance, not just for this year, but for the year after that, down 8.5%. So pressure in that auto space we're seeing today. More reports on autos coming this week. We should also talk about Schneider Electric. So this is, we've got that AstraZeneca screen up. They're down 4%. And I think, look, we've got a solid pipeline from this company. We've got, you know, solid earnings coming on the back of diabetes drugs, on cancer drugs, but also this looming threat of sectoral tariffs that are coming, that there's a lot of uncertainty about that. And let's end on this kind of energy theme. We've got BP and Schneider we need to talk about. BP, again, the question had been about the buyback, and they announced a buyback on the lower end of that guidance. We're seeing down 3.7%. That's some disappointment there. Schneider, they make a lot of the electric things in your house, plugs, chargers, etc., down 6.3% on the back of a disappointing earnings report.
Bloomberg's Charlie Wells walking us through some of those early movers. As Guy said, there are some really significant ones that perhaps aren't showing up when it comes to the surface. We thank you so much for walking us through some of those early movers. I can't quite tell what the narrative is today. Is there even a narrative when we're talking about this market, or is it just everyone stay put until the month turns?
Everyone for yourself with your earnings report. It feels a bit like that.
Yeah, are there themes that unite them? My takeaway this morning is weak consumer. I get a number of CEOs have talked about that. Clearly, tariffs is a big theme at the moment. It's interesting to hear Nicolai talking about the fact that Europe may be getting its act together. Does it feel like that this morning in terms of the narrative that we're seeing coming through? I'm not entirely sure. Europe's just had a major power outage across the Iberian Peninsula. It doesn't feel like we've got our act together very much this morning.
Well, the sentiment when it comes to how a lot of these companies are approaching the States, very, very varied. We're going to talk about the bank sector next. Deutsche Bank, HSBC, and BBVA. That next. This is Bloomberg.
Welcome back. This is the opening trades. We are 30 minutes into our European session, and we have modest gains coming through across European equity markets. So overall, and that's not really where the story is, but overall the indices are moving a little bit higher, making these modest gains, waiting for data points to kick in later on in the week. We've been told, look for the ISM data. We get inventories out of that. That's all in focus. In the meantime, then, US futures edging a little bit higher. But let's dive into some of the specifics around certain sectors, shall we?
So Astra's down quite hard, which I think is interesting. And I'm wondering whether this is because this is a tax beat rather than a kind of underlying business beat. The picture's quite solid coming out of this company, but actually, why have they delivered what they've delivered this morning? And to what extent is this a kind of an accounting story rather than a kind of science story? So I'm wondering, I think that's quite interesting. BP is down. This is an issue of debt and the buyback and the vulnerability. But the whole sector, I think, is really interesting at the moment, given what is happening with oil prices and just how low they are right now. The first of the majors to report numbers. Yeah. Is it a useful indicator for the rest of the sector, or is this idiosyncratic?
And ahead of the numbers, I was reading that they were talking about assuming an average price of $70 over in their new strategy. And so that, and you start to, when you see, the oil prices at 61 on WTI and 65 on Brent, it makes you wonder how intact some of these plans are. And that, for a lot of businesses, is going to be a key difficulty, isn't it, of 2025, getting any certainty on any of the key inputs into their forward planning.
Absolutely. There's one more mover I want to bring to everyone's attention. That is Schneider Electric taking a beating as part of Guy's Core 6 as well. Their first quarter revenue numbers did come in softer than expected. They're still talking about some pretty solid data center investment. As we're talking about the issues over in Spain and Portugal, Schneider Electric perhaps also getting a little bit of a sentiment weight or dampener, if you will. Those shares down a whopping 5.7% this morning.
Rheinmetall's up really strongly. The numbers, according to one analyst this morning, well ahead of expectations. So that stock absolutely surging after a decent run this year. Obviously, the story's faded a little bit, but these are strong numbers, apparently. JP Morgan talking about a very positive view. I think you've got another analyst, I say, talking about well ahead of expectations. These are solid numbers, it seems.
Yeah, so somewhere between that AI theme and the tariff theme, there was the defence theme, wasn't there? And we haven't forgotten about that, so let's remind ourselves. Let's talk about the banking sector then, because some of these stocks are really on the move and making some decent gains today. Deutsche Bank's trading unit hit a record in the first quarter as the lender benefited from market volatility. We spoke to the German lender's CFO, James van Moltke, a short time ago.
The crystal ball is cloudy. As we think about it, though, first of all, our company is well equipped to navigate an environment like this, whether it's risk management or the great client franchise we have, as well as the very strong balance sheet. We're equipped to navigate ourselves and, more importantly, help clients through what is an unsettled environment.
Joining us now is Bloomberg's Jenny Serrain. So interesting that the CFO, yes, acknowledging the sort of cloudy outlook, and there were some references to tariffs and HSBC doing that as well. But thinking about Deutsche Bank, it said it's seen a dramatic slowdown in deals post the trade war. How does that fit with what we're hearing from other banks?
I think it's exactly what we've heard from a lot of the banks this quarter. So, a lot of them are reporting really strong results for the first 3 months of the year, especially in those trading divisions, which really benefited from all the market volatility. You saw clients kind of rushing in, looking to kind of take their positions and stake out their claims. So now you have the sort of after and knock-on effects. And with deal-making slowing down, underwriting slowing down, those are the sorts of things that investors really get queasy about, because those are the sorts of things that can kind of stick around for much longer than just 1 quarter in, 1 quarter out. So definitely, certainly something that we've seen from across the industry and what we expect to hear more later this week as more and more banks report.
Can I just stick with Deutsche Bank before we go on to HSBC? They've raised credit provisions as a result of tariffs. Can you just explain kind of what's happening there? This is US focused. Something's talked about it in the letter this morning.
Yeah, so I think it's something that we're seeing a lot of different banks kind of take different stances on. So I think for the most part, they haven't actually seen any signs of stress yet. Yeah. But the fear is that if you do really see this pullback in trade, this slowdown in GDP, if consumer spending starts to falter, if the U.S. plunges into a recession, that's when things could really get hairy. And so you see different banks kind of taking different stances on, we want to be ready for if, the rain comes in. And so that's, I think, what you saw from Deutsche Bank this morning.
How is HSBC dealing with that problem?
So HSBC, it's interesting because they're really known as this trade bank. They're known as this conduit between East and West. And so you saw them talking about, we have different scenarios. And in our worst downside scenario, it's that trade pulls back and GDP slows. And you saw them talking about, I think it was a couple $100 million of direct revenue impact from that. But again, it was the first 3 months of the year still looking really solid. And I think one thing we've heard from a lot of these banks is it can be in different ways. So if trade goes from U.S. to China, they're good at that. But if trade goes from China to Vietnam to India, then to the U.S., if it becomes more bifurcated, that's actually still okay for these banks, too. They can make that happen, too. So you see them trying to kind of pick their marks and play to their strengths. And that's more of what we saw from HSBC.
So what else are we watching for when it comes to the banking sector then? We're nearly through, are we? Jenny, is that it? We're done with the first quarter bank earnings?
No, not quite. So we have Barclays tomorrow. We've got Standard Chartered later in the week, another big emerging market bank that, we expect to hear a lot from on the tariffs and trade front. So I think we're still in the middle of the earnings season, as it were. And I think the main thing really is, how are you navigating these tariffs? Are you seeing clients start to draw down? Are you seeing any signs of stress? How big of a risk do you really think a U.S. recession is? So these are all questions we're still asking the rest of this week.
Not done yet. Jenny, great stuff. Thank you very much indeed to you and the rest of the team. Some fantastic coverage coming through of the bank reporting season. Kriti, as ever, slightly obsessed, not just with banks, but with Spanish banks.
Absolutely. Well, I think it's a lot of what Jenny was just talking about how do banks around the world, regardless of region, deal with the likes of tariffs, deal with the likes of banking consolidation. I think BBVA is a really great example of a bank that is dealing with both the tariff threat in the United States, not just in terms of Europe, but how they're reacting to the likes of Mexico. BBVA is a Spanish bank, the largest financial institution in Mexico, so directly exposed to things like the auto lending, some of the manufacturing, some of the reshoring themes. But then they're also in the midst of a big kind of Sabadell takeover, or attempted takeover, I should say. We're awaiting a result on that. I spoke to BBVA CEO owner Yank about that very concept.
In Europe, different than US, 75% of corporate borrowing comes from the banking system. In the US, it's 25%. The rest comes from capital markets. In Europe, unfortunately, capital markets is too small, so the banks provide the funding. Banks provide the ammunition to invest, to companies to grow. So you need banks, you need strong banks, you need profitable banks. And in the context of the fixed costs becoming larger in banking, you need to be large. In Europe, unless we solve this issue of scale, we cannot really compete as Europe, and we cannot really grow as Europe.
That, of course, Onur Genç, the CEO of BBVA. You can catch more of that interview with the CEO and my profile on the CFO as well. Luisa Gomez-Bravo is all part of Bloomberg's Chief Future Officer. It's now currently out on YouTube. It was a really fascinating conversation because these are two folks who have spent time around the world, not just in Madrid, have brought that skill set back. And they're talking about doing kind of the opposite of what everyone else is talking about. If you're worried about deal flow activity, about pulling back, BBVA is leaning forward. If you're concerned about tariff exposure, BBVA is actually investing more towards the likes of Mexico or even likes of Turkey and not pulling back. So everywhere, they're kind of taking the contrarian approach, and we'll see if it works.
Yes, although you wonder if anyone was doing anything yesterday.
Yeah,
at BBVA or any of the Spanish or Portuguese banks.
Well, the irony of this whole thing is that we were actually expected to have a CNMC decision. So that's the Spanish regulatory authority looking to potentially sign off on the Sabadell takeover, which we know has been deemed a hostile takeover. That has now been delayed because, as you say, they couldn't get through and they couldn't actually make that decision making. So we are on deal watch when it comes to that. You are, of course, seeing live pictures of some of the chaos in Spain at the moment. This is the Outage train station you're seeing live on your screen at this moment. Let's go to that story next, if we can. Spain and Portugal returning to some semblance of normality after suffering one of Europe's worst blackout in years. Many questions remaining about what caused the power outage. For more on this, we're joined by Laura Millen in Madrid. Laura, walk us through the latest there. Is the power now back?
Yes, the power is now back in most of Spain and Portugal, and things in the streets seem pretty much back to normal. Phone connection is still on and off at times, but yes, things are pretty much back to normal.
Do we know what happened? Why did this happen? This is obviously a huge crisis for the country.
No, that's the big question this morning in everyone's minds, including, I guess, the governments. We still don't know what caused the outage. What we know is that 15 gigawatts of power disappeared from the Spanish grid in just 5 seconds. That's about 2/3 of the supply that normally runs through the grid in any given day. It disappeared almost instantly. What the grid operator has said is that there were oscillations of supply of power in the grid. We don't know what caused these oscillations, these variations in voltage, and this is the big question on everyone's minds right now. Prime Minister Pedro Sánchez appeared yesterday night and said that the technicians that are working on this, looking into this, still have no answers. And he's speaking later today. He's holding a cabinet meeting, I think, right now as we speak. And he will, someone from the government will then address the press. We hope to hear more. But so far, there are no answers on what caused the massive blackout yesterday in Spain and Portugal.
Laura, thank you very much indeed for the update. We greatly appreciate it. Nice to see the lights on in the Bureau. Laura Millen joining us in Madrid. What are we going to be talking about next? President Donald Trump about to hit his 100-day milestone this week amid unprecedented tariffs, unprecedented everything, actually. We're going to look at the impact on European earnings, what is happening in terms of the corporate story this morning. This is Bloomberg.
The tariffs, which is, of course, disturbing a global company massively with our production in the US and in China.
Global trade uncertainties we're seeing at the moment, we would expect that the subdued consumer to continue for a while.
We believe that tariffs are not the best way to manage this, to manage pharmaceuticals.
Are you expecting the tariffs to come back down? And again, you don't know whether a tariff is put in place now.
I don't know. I think there is one guy who knows, and it's not me.
That one guy, 100 days in office, some of the business leaders we've been talking to this morning, commenting on the impact the tariffs are having. President Trump hitting a 100-day milestone this week. We've got a big event in Detroit tonight. During his time, he's launched an unprecedented global tariff war, and he's left countries scrambling to respond. This all comes, of course, during a busy week of corporate earnings, which we've just been hearing some of the leaders talking about. Josh Gallo, Bloomberg Global Business Editor for Europe, joining us now to discuss all this. Josh, we're hearing from CEOs. Clearly, everybody's being asked about tariffs. What are we learning? What are European corporates thinking about in terms of the tariff narrative thus far and where it takes them next?
Well, part of what we're hearing is that they don't know. All we know now is that they are there. They're far more than people expected, and there's a great deal of uncertainty about how they're going to be resolved going forward, or what final rates are going to be reached in the discussions. You know, the earnings we're seeing now from the first quarter, of course, they take into account the first couple months of Trump's administration, but the real impact of, you know, the Liberation Day tariffs, the reciprocal tariffs were announced on April 2nd. So we're not really seeing an impact on numbers per se, but we have seen a number of companies change their outlook for sales and earnings this year. Porsche, you know, the car industry is one that's being hit very hard, and we saw that with Porsche today, with Volvo, both of whom cited the tariffs. Volvo said it's going to cut costs and some jobs. Porsche lowered its outlook for the year. They, of course, all the cars they sell in the U.S., its biggest market, are imports. They build them in Europe. So they're obviously going to, they face a major challenge with this. Going forward, we really don't know. It just is it's a question out there for everyone where these rates are going to end up.
Well, Joshua, when you start talking about some of how these corporates will react to this, how much of the answer is ultimately in pricing power and price hikes and the amount that they're charging their customers, not just in the States, but right here in Europe?
Well, you know, the consumption in Europe has been lagging, so the capacity for companies to raise prices here isn't necessarily great, right? Especially when you think about cars. That was most evident when the European Union decided to slap tariffs on Chinese EVs, which would have come in much lower than European car manufacturers were able to compete with. As for the U.S., you know, that remains to be seen. Today the administration, I suppose yesterday, the administration said it would give a little bit of a reprieve on some of the auto parts tariffs, parts that are imported for cars that are made in the U.S. That will give a little bit of relief to makers like Volkswagen, makers like BMW. That will help them. But the capacity to raise prices, especially given the rest of the economic weakness that we're seeing in the U.S. and elsewhere, I don't think that's what we're hearing from corporates, that they're going to that they feel confident in that regard.
Joshua, thank you very much. Joshua Gallo, Bloomberg's Global Business Editor for Europe, joining us there to talk about the corporate landscape, how it's being affected by tariffs, 100 days this week, of course, into the Trump administration. Joining us now with more of an eco take on where we are across the European economy, Anna Titareva, European economist at UBS Investment Bank. Anna, nice to have you with us. So our focus is often on inflation. We're talking about tariffs a lot and talking to company CEOs about what that's going to do to inflation in the United States. Here in Europe, the conversation is a little different, though, because the inflation dynamic, how this plays out, will be quite different. We're looking ahead to inflation data due out on Friday. What's your overarching expectation on the inflation front?
Yeah, when we focus more short term and looking ahead for the inflation print on Friday, we expect headline inflation to remain stable at 2.2%. But looking beyond Friday inflation print, we do think that we are firmly on track for inflation to get back to the ECB's 2% inflation target. There are two factors at play. First, we of course benefited from big drop in energy prices after the announcement of the US tariffs, and as a result we have adjusted down our inflation projections. On top of that, we also got a bit of a surprise in terms of currency reaction, very significant strengthening in euro, which is also disinflationary. So against this backdrop, we've adjusted down our inflation projections. And in fact, we expect inflation to dip below 2% in May, and then essentially to hover around 2% for the rest of the year, which is a bit lower compared to what we expected about a month ago.
Okay, and whenever we hear from European officials on this front, they talk, if we're talking about tariffs, they talk about not wanting to see tariffs, and then they talk about the importance of not allowing China to dump product into Europe. Where are you seeing any signs that cheaper product from China is getting in, or where do we look to see any evidence of dumping into the European markets? When is that on your radar?
So that's certainly a concern. That's one of the disinflationary forces that we have flagged in the context of U.S. tariffs. At this stage, it's a bit too early to judge based on the incoming data whether we're seeing signs of that. But I think it's important to flag that it's something that is of a concern for policymakers as well. You know, we've seen some statements even from the European Commission that they will try to prevent it, that they will try to put some mechanisms in play. So we think that there is awareness around this issue. One channel of transmission, of course, would be to monitor, goods prices. But of course, at this stage, it's a bit too early to firmly say whether there are any signs of this taking place.
Anna, are you seeing evidence of almost bracing or preparing for the tariff impact? So much of the data we focus on in the States and in China, as Anna mentioned, has been kind of front-running the tariff impact in terms of warehousing. Are we seeing evidence of that in Europe when it comes to consumers, but also businesses?
So I would say that when we look at the latest PMI release, we've seen some tentative evidence of that. In particular, when we look at the commentary from German corporates and in the manufacturing sector in particular, we've seen that in general, manufacturing PMI held up a bit better than was expected. And based on the comments from the companies, there was a bit of sort of front-running in terms of orders and in terms of stockpiling, given the risk from tariffs. So that's sort of soft evidence that we have so far from the company's perspective. From the consumer perspective, a bit less so, especially because what would be a concern for European consumer would be Europe retaliating and increasing import tariffs, which would be the inflationary element. And so far, that hasn't happened.
You come to us from the UBS investment bank specifically, and I know you're an economist, so bear with me here. So much of the narrative around the deal-making space and the investment banking space is really ultimately tied to confidence when it comes to how Europe can actually weather these tariffs, as you point out. Is there a change in sentiment from the vantage that you have when it comes to some of this deal-making, especially given in just the last, I believe, hour or so, we heard the likes of Google and Alphabet, for example, accessing the European debt market?
I mean, from a macro perspective, it would be difficult to comment on the deal-making sentiment, but I would, in general, comment that there is an improvement in terms of sentiment towards Europe. And we've seen that gradually building up since the start of the year and getting even stronger after the announcement of big fiscal stimulus in Germany. So definitely we see more interest from the client perspective, not just from Europeans, but also outside of Europe to talk about Europe. And we've also seen that in terms of, performance of the currency and also equity market to some extent.
Does the UK still have an inflation problem?
It's got more of a problem compared to the Eurozone. Of course, in the UK, what we are seeing is that on the one hand, the impact from U.S. tariffs is likely to be somewhat disinflationary. So again, story of falling energy prices, strengthening of sterling. But when we look at more domestically driven inflation, in particular services inflation, that part still remains quite sticky. And of course, we have to remember that April is going to be a very important month because that's when we get increase in various taxes, also some regulated items. So we are likely to see a jump in services inflation, in core inflation more broadly in the UK. But overall, looking beyond April jump, we do expect that we are likely to see a gradual decline in...
So the bank should look through this? The Bank of England should look through these numbers?
Yes, that's our view. So we think that this jump in inflation in April is going to be, to some extent, a one-off price level adjustment. So we don't expect significant second-round effects. So against this backdrop, we do expect sort of gradual decline in underlying inflation that should allow the bank to continue to ease.
Anna, we're going to leave it there. Thank you very much indeed. Great to see you. Thanks for setting us up for all the data we're going to be getting throughout the week. And Anna Tereva, European economist at the UBS Investment Bank. A few stocks really stand out this morning. Rheinmetall is definitely one of them. The numbers that it's delivered this morning are super strong. We're dealing with, obviously, a series of kind of idiosyncratic stories, but actually they fit into the broad buckets and themes that we've been talking about. What is happening with defence? What is happening with the consumer story in Europe? What's happening in terms of the tech story? It's interesting to see what is happening there, and we're looking forward to the big tech earnings coming through. But the Google news this morning, I think, is interesting in terms of what it tells us about funding as well. So there's a number of kind of really interesting themes running through this market today.
Absolutely, and you were the key one to point out some of the moves that you saw on the defence names. Rheinmetall, I think, was the one that you mentioned, so higher by almost 7% this morning. You're seeing a lot of the optimism, at least in Germany, show up in some of the banking sector as well. Deutsche Bank was what caught my eye, specifically because pre-tax profit not only exceeded expectations, but Christian Saving talking about its best quarterly profit in 14 years. That being reflected in the market, higher by 4.4%. But all the banks having a good day, frankly.
Yeah, the banks having a good day. So despite the fact they are citing tariff concerns, they're sort of proving to be, at least in the very short term, a little insulated. Let's have a look at the pharmaceutical space, because we spoke to the CEO of AstraZeneca a little earlier on, Pascal Soriot. He was pretty bullish. He was cautioning against tariffs, but saying that it wouldn't impact the business too much. Analysts, in retrospect, or having seen the numbers, noting that margins and earnings per share have held up better than feared, but saying that they think that the business has missed on oncology and rare disease sales, and that seems to be where some of the negativity has come from when it comes to AstraZeneca, because that stock down a little more than... It's
also been helped by the tax story as well, so the numbers have benefited certainly from the tax read onto the business, so that's another factor that probably is worth bearing in mind. Porsche's having a very bad morning. Very bad morning indeed, and it's the second warning effectively that we've had from this business in as many months. It's very difficult at the moment to sell a high-end car in the United States, unless of course you're Ferrari.
Yeah, and the Ferrari CEO will be joining The Pulse exclusively from the Norges Bank Summit. So Francine Lacroix has been out there all morning. She continues her conversations from there. That starts at 9:45 a.m. UK time. US futures pointing a little bit higher, bouncing a little bit as we've been going through the programme. Not stunningly so, but Nasdaq futures now up 0.5%, waiting for key earnings out of the United States. Any further news flow surrounding tariffs, of course, could be influential, and waiting for key data points as we get towards the end of the week. That is it for the opening trade. The Pulse is up next. This is Bloomberg.